Hello everybody and welcome to today's webinar in which we are going to continue our discussion about the rising Brisbane market. I'm Terry Ryder, founder of hotspotting.com.au. My special guest today is Mark Shorrock, the Managing Director of Bluestone Property Management and Sales. Now, 2 weeks ago, I presented a webinar in which I discussed a series of reasons why I believe the time for the Brisbane market to shine has arrived. I think the Queensland capital will be amongst the nation's leaders on price growth in the next 5 to 10 years. But it's a mistake for investors to believe they can buy a property, any property in Brisbane, and make a killing. Even in a booming market, investors need to carefully consider their strategy, what they buy, where they buy, and how they behave as a landlord in a strong rental market. So to discuss these issues, I'm joined today by Mark Shorrock of Bluestone Property Management and Sales. Mark, welcome.
Good morning, Terry. Well, good afternoon, I should say. It's just ticked over here in Queensland. And thanks for having me. And good afternoon to all the attendees here today.
Yeah. So, the Brisbane market seems to be top of mind for both home buyers and investors, because we've got a lot of people moving to Queensland, particularly southeast Queensland, as internal migrants, people leaving the biggest cities and moving to areas like southeast Queensland, but also a lot of investors. A recent survey by PIPA, the Property Investment Professionals of Australia, indicated that Brisbane is the #1 choice for investors thinking about buying a property in the next 12 months. And I imagine that you're feeling the effects of all of that with what you do at Bluestone.
Yeah, Terry, we're having been involved in real estate. I guess my parents were in real estate, and having done it myself for 23 odd years now, that you get to become familiar with the cycles, and it's good to see that we're back into the stage of a cycle where investors are not only entering the market again, they're competitive in the market and competitive against owner occupiers who sort of outbid the first home buyers from the market. So we're seeing on the cold face a lot more investors inquiring on properties, offering on properties, and transacting on those same properties. And it's good to see that people coming back, and also likewise good to see those people who have previously been in the market and persevered, I guess, with somewhat of a stagnant market for possibly 10, 12, maybe even 13 years, seeing some of the rewards for that perseverance, increased rental returns, increased capital growth, just increased values in general. So it's very good to see.
Yeah, and I think one of our key themes today is going to be that while markets are rising strongly right across Australia, in fact, but Brisbane in particular seems to be very strong. Properties selling quickly, very busy market, very competitive market. I think the behaviour of some investor buyers suggests that there is a belief that they can buy pretty much anything and they're going to be okay. And I think what we like to talk about today is the need for people to, even in a market like this, consider carefully what they're buying and where they're buying, and particularly how they set up a property as an investor to extract the maximum benefit out of it as a landlord.
Yeah, that's right, Terry. One thing I'm often saying in the rhetoric is that there's so many variables in property that make it hard to really sort of, I guess, put a blanket over it and say here's a one-size-fits-all solution for everybody. You've got a different investor with different strategies, different property managers, tenants, different locations, different styles of property, different ages of property. All of those factors are very hard to sort of, put into a box or a checklist and say, it really comes down to getting your ducks lined up in a row as an investor, coming to someone like yourself to seek independent location advice, and then narrowing down through your property type from the location, and then timing, and then entering into the market, and then lastly choosing a quality property manager to as an further investment to maintaining the property to its highest and best value.
Yeah, so I think one of the problems is that media in particular tends to generalise about their reporting of real estate. So we have one median price for Brisbane, we have one vacancy rate for Brisbane, and what you in particular are in a position to know very, very well that even though overall vacancies of Brisbane are I think the official figure recently published was 1.3%. There are parts of the Brisbane market where vacancies are still high. So I think we could perhaps start our discussion by differentiating between the inner ring, the middle ring, the outer ring, and the situations that exist there, and the need for investors to be careful about what they buy and where they buy.
Yeah, that's exactly right, Terry. So, for instance, we're a little bit unique to the traditional residential agency, like to say the franchise groups people would be accustomed to, Ray White, LJ Hooker, that type of thing, in that we're centrally located in just north of the city, CBD of Brisbane, but we manage properties all over Brisbane, from Logan in the south, through Brisbane, through the CBD, in those inner to middle to outer rings, all the way up to north of North Lakes and the Moreton area. And so we get to see a sort of vastly different landscape to a traditional residential agency, and we experienced that firsthand in that with the lockdowns and/or even though Queensland wasn't as impacted or affected as much as what Sydney and Melbourne were, that still a lot of the bigger corporations and the government sector withdrew their workforce from the inner city, and that decreased demand for those inner city rental properties, primarily being units. Coupled with that, at the same time, the university students weren't here, so additional decrease in demand from those people. When we look at that, that has sort of primarily driven the vacancy rates for those inner city apartments or units and or townhouses up. Compared to those people being out in the suburbs, in the middle to outer ring, we couple that situation with the high interstate migration from people moving interstate. Now, a lot of people moving interstate are asking us, they want a property with a yard. They might have come out of Sydney or Melbourne and been in lockdown in an apartment with only a patio or a deck or a balcony, whatever you'd like to call it, or a small courtyard, and they're coming up here and they're looking for a bit of space. So that's put an extra demand on the houses in the middle or outer ring, which is always, as you would be able to, I'm certain, validate that has always been a good bet for investors, that sort of middle housing market. You're sort of hedging your bets between a mixture of traditional investment in that units and apartments will traditionally see a rental return, let's say, just for ease of explanation, between 5 and 6%, compared to houses receiving a yield of around about 4 to 5%. Contrast that, what a similar effect that happens is that the inner city apartments would traditionally receive potentially a lower capital growth to offset that higher yield, and likewise the houses in the middle or outer ring might receive a higher capital growth with a lower yield, with a similar net return over any given period of time. But it does certainly make houses in that middle to outer ring far more appealing as an investment. But there are still good opportunities potentially at some stage for investors to jump back into the unit market in that inner city. It's about the timing and getting it right, picking that before that will go again. It will move again, but it's just trying to pick when.
Yeah. So what we have seen, and we've been charting it quite regularly, that we've seen the vacancy rates in those inner city postcodes, the CBD, near city suburbs like Fortitude Valley, Wollongabba, Kangaroo Point. They have come down considerably in the last 12 to 18 months, but the CBD is still high. Last figure I saw was about 8% for CBD vacancies. People do need to keep that in mind, and as a consequence of that, we haven't seen much in the way of value growth. In fact, we've probably seen overall median prices over the last perhaps 4 or 5 years decline. That does represent perhaps good value for money buying opportunities, but people do need to be aware that vacancies do continue to be higher than we would like them to be, particularly in the CBD.
Yeah, it's certainly a good opportunity any time for an owner occupier, but for an investor, yeah, it's about timing that. I think, let's say we could generally around maybe not in the CBD, but the suburbs around the CBD and that inner ring, I think that we could probably say, for ease of an explanation, the vacancy rates might have set on average around 4%, but they're probably about half of that now. And likewise in the middle to outer ring, they were sort of let's say 2% or slightly less, and at least 1 or slightly less than 1% now. So we're seeing in some of our suburbs, vacancy rates, a couple of points underneath 1%, which is fantastic to see. And that brings about a whole nother challenge for investors, because the other thing it's probably timely to mention is that because property or rental prices haven't moved so much for sort of that 10 to 13 years, and the reason being the demand from tenants, a property might sit vacant for a month or 2 to 3 years ago, is now sort of renting in probably less than a week. Owners have been, or investors have been forced to put up with possibly poor quality tenants, have been reluctant to move them on because they didn't want to experience or couldn't afford to experience a vacancy period. We're at a position now where demand is so high for rentals that a lot of investors have moved those undesirable tenants on. Maybe they have a long history of rental arrears, or not maintaining the property cleanliness and damage-wise, exceeding the bond, so it ends up being a cost for the investor. Moving those tenants on and then freshening the property up and re-renting it for 10, 15, maybe 20% more than they were before. But, the challenge is for an investor is sifting their way through the multitude of applications. We would be getting probably 70 to 80 inquiries on the average property with 30 to 40 applications, and working your way through those applications, narrowing it down, sifting out the undesirable tenants and getting it down to a core group of quality long-term potential tenants. I
think it'd be fair to say that when you've got that many applicants for a single rental property, because vacancies are generally speaking low, an investor owner should be able to end up with a good quality tenant, provided their property manager is doing their job properly. And I think that's the key, isn't having a good property manager on the team to make sure that process happens and you end up with the pick of the crop as the tenant.
That's right, Jerry. It's easy, given that property managers are so busy, though, it is easy for an inexperienced or a property manager with not a lot of overarching management within the business to maybe take the easy route and pick what appears to be a good quality tenant early to save himself a bit of time. But it can actually create, while you save time in the front end or in the short run, it can create a lot of extra time and effort and cost for the investor in the long run. So it's definitely worth, if a property sits empty for an extra day or two, and that's the time it takes to go through and screen those tenants or applicants thoroughly, looking at current employment, previous employment. We're looking at not just their current rental address, but their previous rental address as well, and not relying on what the other property manager's saying, because we're finding there are a lot of property managers, unfortunately, being quite ambiguous on the rental references because they're trying to, I guess, the rental market is so challenging that if they've had a poor quality tenant in a property and they answered every single question that we sent them on a rental reference truthfully in detail, a lot of agencies wouldn't rent to those same tenants. So if a good, probably the best explanation I can give there is the question would be, has the tenant been in rental arrears? And rather than saying, yes, they were in rental arrears a dozen times in the last 12 months, they would have an answer which would say, refer to attached ledger. And that's putting the onus back on the property manager that's checking the rental reference to go through the ledger and ascertain whether that tenant was or wasn't in rental arrears.
So would it be fair to say then that a nice compromise situation for an investor to consider, and when looking at the Brisbane market, is those middle ring areas which offer a nice balance between affordability, good prospects for capital growth, and a pretty decent rental yield, with low vacancies being a factor as well?
That's correct, Terry, yeah. And managing the vacancy, while the demand is so high for rentals, it doesn't mean that the rent you can charge is unlimited. There's still a ceiling on the market. At some point, an ambitious investor setting the bar too high will reach a point where we won't get inquiry, won't get applications, and they won't get a tenancy. So trying to manage that is challenging, and it is hard. And we've got a moving feast at the moment, so it makes it challenging, even with someone as much experience as I've got, trying to ascertain or narrow down that potential rental price for an investor. And there's a bit of personal preference comes in, and also situation. So if an investor can afford maybe to have the property sit empty for a week or two and be a little bit ambitious with the price, we're definitely willing to give that a go and provide feedback and, hopefully secure a tenant at that increased rent. If not, make an adjustment to the rent where we see the inquiry and the applications increase, and then give ourselves a better chance of putting a tenant into the property.
This is a bit of an aside. So something we're hearing anecdotally quite a bit around the country is that an investor owner might have an asking rent for a property that's become vacant, but prospective tenants are actually offering more than the asking rent to get to secure the property and beat the other competing prospective tenants. Are you finding that happening in your markets?
Yeah, we are, Terry. That's exactly what's happening. In that I guess the other strategy to being ambitious on the price is making it extremely competitive and getting a high amount of inquiry. When tenants turn up to a property to do an inspection, they see 30 or 40 other groups of people, and we are seeing tenants offer extra money. Now, in Queensland, and I think it's fairly similar in other states, we can't ask tenants to pay extra rent or offer extra rent, but we can't stop tenants from doing so. So early on in the piece, when the market started moving and we hadn't seen rental prices increase for, say, 13 odd years, tenants weren't accustomed to the fact that they could offer more money. That was quite challenging. Some tenants who were quite savvy got in early and offered extra money, secured properties. So that is definitely another strategy. However, we have seen a couple of times where we thought we were doing that, and we did do an increase, and we thought it was going to be competitive, but that was the only price that we ended up achieving. So like anything, property investment, it is a bit of a gamble. There is a bit of risk associated with it, but also high rewards. So it really comes down to us. Is what we try and do as property managers is provide all the known options and scenarios and outcomes so that our investors can make educated, well-informed and strategic decisions. Because as I said before, so many variables, what I might do is slightly different to what you might do, slightly different from what Katie might do. So yeah, we just have to manage our way through that process.
Okay. I just want to pause briefly and just mention to people out there watching and listening that if you've got any comments or questions, please type them into either the chat box or the Q&A panel, and we will make time available before the end of the broadcast. We're going for about an hour. We usually try to leave the final 15 or 20 minutes available to answer questions. So if you have any or comments, please bang them into the chat box or the Q&A panel. Mike, could we talk about the prospects, the pros and cons of apartments versus houses in terms of the general prospects for an investor owner?
Yeah, that's. I'm glad you mentioned that, Terry, because naturally people their options are determined by their personal situation and circumstances. So someone with a limited budget or potentially limited serviceability might be forced to only be able to afford a unit. And that is better than no investment at all. As we said before, the unit market will come back as it always does. Houses are market, they come in. It's not one market, as you said. We've got markets within markets within markets, from suburbs to areas, proximity, location, property type, all of those different factors. So that's the first thing. Secondly, just to give, I always like to use a case study to make it relative to people. I was on the phone to one of our investors the other day, and we managed a property for him, and we were discussing the potential for a rent review and different things like that. And he made mention in the conversation that he owned another property he bought around a similar time. So we managed a unit for him in a suburb called Kelvin Grove, and he purchased that unit in 2015 for $535,000. Now that property rented then for about $470 a week, and still rents for about $470 a week now, 6 odd years later. That's a gross return of around about 4.56%. The house that he bought was in a neighbouring suburb, which is in Red Hill, and he bought that in 2011 for about $75,000. And in that time frame, between 2011 and 2015, as you would know, the property market really didn't do much. So there's probably not a lot of difference between buying those properties. But that property, the house in Red Hill, between 2011 and now has doubled in value. So around about $1.15 million, but only rents for about $460 a week, which is the return is around about half. So as you can see, while the investors out there that are listening to the webinar today can see that while the capital value of the property has doubled, the rental yield is halved, and half that of what you would get from a unit in a neighbouring suburb. So at the end of the day, I think it comes down to personal preferences. You might get higher rental yield, and it depends what you do with that money. If you can go and put that back against the mortgage, obviously that will help, other than spending it elsewhere. And as I said, that personal circumstances might prevail. And if you've only got $300,000 or $400,000 to spend, you may not be able to get into the housing market unless you're prepared to go out into the outer rings of Brisbane.
It can be a choice between, with apartments, you tend to get a higher rental yield, but with houses, generally speaking, better capital growth, and as you say, it can come down to personal preferences or the affordability, the price range that the buyer might be able to go to. The Calvin Grove example you mentioned, that's very close to the inner city of Brisbane, which has been afflicted by high vacancies in the past few years. So that's a factor there.
Yeah, so we're seeing that the property and the rent sit pretty stagnant, and as opposed to the other one, which is increased, and the rent has stayed the same, but the property value has increased. The investor went in and paid $1.15 million for it. Today they're only looking at about 2.65% return or something. I think it is off the top of my head. But yeah, another factor is the body corporate, which a lot of people don't think about. Is that is, if you look at a case study for a body corporate and look at side by side, a really well-run body corporate as opposed to a house, pretty much it's about dollar for dollar. I think I did this detailed scenario on this about 7 years ago, and at that time it was say $36 a week for a body corporate, and if you were to pay for the same things on a house, you'd be spending $34 a week. The difference really is the profit that goes to the body corporate manager for their time and effort to manage all of the services that are encompassed within that there. What is the variable is a poorly run body corporate as opposed to a well-run body corporate. So some investors can get caught up in a complex with a high body corporate that's poorly run, and they're pumping money into it that it isn't being spent back on the property. We see that a complex is the street appeal as a house would be for any purchaser, owner, occupier, investor. So when you look at a well-run body corporate, the gardens are neat, tidy, well-maintained, the paint is up to date, all of the fixtures and fittings around, lights and everything work like that, those units are worth a lot more than a poorly run body corporate. So that's definitely a factor that investors need to take into consideration.
And just harking back to early on in the conversation, we were talking about the middle ring areas of Brisbane as being kind of a nice compromise between all the factors: affordability, vacancy rates, rental yields, prospects for growth. David's asking how you define middle ring in Brisbane. How far out from the CBD? What sort of distance are we talking in Brisbane when we talk middle ring?
Yeah, you're probably a better person to answer that than me, Terry, but I sort of consider it 2 kilometres from the CBD is the inner ring, and then 2 to 10 kilometres is, from my understanding, the middle ring, and 10 to 20 being the outer ring. There are other things within that, like Brisbane, we're dissected from west to east by a river, being the river city, and then whether a suburb has proximity to a bridge is a determining factor here in Brisbane because of that dissecting river, and then that the proximity to schools, infrastructure, roads and shopping centres and those things. So that's just not a hard and fast 2, 10, 20 kilometre ring. There are variances within that. So
so on the north side of Brisbane, suburbs like Nudgee, Nunda, that sort of middle ring. But then when you're getting out to the Redcliffe Peninsula, Kalanga, Petrie, Caboolture, we're talking outer ring on the north side.
Yeah, Castle Diamond and up that way across. And then down south, it's pretty much the border is almost when it transitions from being Brisbane to Moreton in the north and Logan in the south is a good way to look at it as well.
Okay.
Yeah.
So let's talk about strategies around rental reviews. And I know we've talked in previous webinars about the pros and cons of going too hard with seeking rental increases. And in a climate like this, I think perhaps landlords might be encouraged to think that they can, when a rent review comes due, that they can really whack up the rent quite strongly because vacancies are so low, demand so high. But I think you have previously presented data showing that that could result in a vacancy period, and the landlord over 12 months might, in net terms, be the loser in that kind of a strategy.
That's correct, Terry. So it's just a balancing act again. So the crux of it is the contrasting strategies, I guess you could say, is a low yield, high occupancy strategy, and versus a high yield, low occupancy strategy. So that's a low rent. Tenant might be in the property for 3 to 5 years, 100% occupancy. Traditionally, that will yield an investor a couple of things. It would net them more money in their back pocket typically, and has lower wear and tear on the property. Generally, the tenants will appreciate that they're on a good wicket. They know they're getting a good return on their investment for their rents for the property that they're getting compared to their friends that may be paying more, and they're not having the inconvenience of having to move regularly. Plus, the highest amount of wear and tear occurs on a property when tenants are moving in and out, which is another factor investors don't take into consideration. When we compare that to an investor who's always pushing the limit on the rent, typically tenants, sees that they might be able to get better value elsewhere, and they move. A bit of a false economy for them because the average cost to move for a tenant we've calculated is around about $3,000, and they get a higher turnover. So they get a higher rent, but a much higher turnover of tenants. So I put some numbers here together for the attendees today. So if you can balance an increase, it can help ensure 100% occupancy and no loss of rent. So scenario would be the rent is $430 a week, and we did a modest increase of $30 a week, even though the market might support 40 or 50. That investor will yield an extra $1,560 over that 12-month period of rent. Verse that to the higher increase, let's say $50, and then the tenants moved out. We had a vacancy period of 2 weeks, plus the cost of a letting fee at 1 week's rent and advertising at $100. That comes at a cost to the investor of around about $1,536. Now, the net gain to the first option is about $3,096. So I don't know any investor out there that couldn't do an extra $3,000 in their back pocket to put towards either their mortgage or updating and improving the property.
Yeah. So basically, there's value in keeping a good tenant, not pushing the envelope too hard when it comes time to review the rental, maybe getting a more moderate increase than you think you might be able to get, because you're avoiding that vacancy period, the reletting fees and the wear and tear on the property of people moving out and other people moving in. Yeah,
that's right, Tim. We're trying to have those conversations with an owner and the investor and the tenant, and just we support when we send a rent review out to the investor. We substantiate it with some market research. So we'll jump in, research the current rentals, what tenants are paying, select at a minimum of 3 properties, send a bit of a report to the investor with providing details around their options and the different strategies and potential outcomes. And then let them come back to us with either some questions or instructions. And then likewise, we just don't, if there's an increase there, not be insensitive and just send a new lease to the tenant with a higher amount. And it's going back to that tenant with a phone call and then following it up with an email, substantiating that increase with a similar but slightly different, differently worded email, which explains that, as they would know, the demand for rentals had increased, and that's put extra pressure on the pricing, and other tenants are paying more. And often, if we're fortunate enough, we're able to go back to a tenant and say, look, Terry, while the investor could possibly get an extra $50 a week, they appreciate your tenancy and they're only increasing the rent by 30. And the fact that in Queensland, tenants haven't had rent increases for 13 to 14 years. So initially, this came at a real shock for tenants. If we rang them up and said, "Oh, the owner's putting the rent up," they were, surprised. But now there's enough media and talk out there that I think you have to be living under a rock not to realise that the rental market has moved considerably. Having said that, though, we do have a couple of other investors who have, while they can get increases, have chosen to keep the rent the same. They appreciate their long-term tenants. They may be negatively gearing. Now, we are not in a position as agents to provide financial advice. So as a scenario, this is a live example. The investors were heavily negative gearing, and they chose not to put the rent up and pass that saving on to the tenant. Their preference was to give the tenant a saving or keep extra money in their pocket rather than give it to the taxation department.
Okay, so let's talk a little bit about the importance of having quality management in a market like this, or in any market really. But I think just harking back to our comments at the beginning of the broadcast, there's perhaps a danger of complacency when the market's so strong and vacancies are so low to think that any investment's going to be a winner. But I think it's important to tick all the boxes, and one of those, the most important, is to have quality management.
Yeah, that's right, Terry. It astounds me when people go and spend, let's say, $500,000 in Brisbane, might be the cost of an average investment property. They spend all of that money. They work very hard for that money, or they go to the bank with a large deposit, and then they're committing to paying off a large sum of money to the bank. And then they go and skimp on discount property management, and they use a property manager while they think they're saving money. It ends up being very costly in the long run through a couple of poor mistakes, through, let's say, poor tenant selection, poor ongoing inspections and maintenance of the property, ultimately determining the end value of the property and any equity, and giving that investor the opportunity to then go and buy other investment properties. As if you're going to spend $500,000 in investment, invest in quality property management. A property manager that has the time and the resources at their fingertips and support to find and screen and secure quality tenants for you. And that means they also have the time to maintain the property to its highest and best value, and that's the highest rent, and that helps you get the highest valuations and the highest equity. And that's what investors are here for at the end of the day.
One of the greatest reasons to have quality property manager on your team is the importance of understanding the prevailing laws that govern rental properties. And people who perhaps try to self-manage, for example, may not be fully aware of everything they need to be aware. And that's particularly relevant in Brisbane at the moment, because we do have some changes coming up in terms of the laws that govern rental properties. Yeah,
correct. Just last week, I think it was passed the rental law reforms for the Housing Legislation Amendment Act 2021, Terry, and that's made it extremely challenging. What is already a very, very tough job, and knowing what I know about it, property investment and property management, I certainly wouldn't try and manage a property myself. If I wasn't doing what I was doing, even knowing what I know, I would engage the services of a professional, because the legislation now is sort of so in depth and therefore what's the word I'm looking for? It's sort of complicated and somewhat convoluted and ambiguous, open to interpretation, that it's a minefield for an investor out there that tries to do it on their own. We even see people that do this for a living, the property managers, making mistakes occasionally, as we do. We're only human. We don't get it right every time, but we can mitigate loss for investors through researching and asking questions of these regulation updates and getting a very good understanding for them and managing their way through that minefield. So a couple of the new laws that have come in, one that was the first one which has been adopted was a regulation underneath COVID, was domestic and family violence, DV protections, which means a tenant who's experiencing domestic violence can effectively move out of a property within 7 days without any penalty. That's rent, cleaning, damage. So we need to be very mindful of managing those situations there. We naturally, as the industry and as property managers and estate agents, licensees and investors, we want to try and protect anybody in that situation, but it also needs to be fair for the investor or the person who's worked hard and parted with their hard-earned cash and committed to paying off that property to provide a home for those tenants. So we need to balance that out. And again, that comes back to tenant selection and then the management process. The next one of the 4 major laws is the ending of tenancy fairly. So previously, or up until soon to be in the future, an investor can issue a tenant notice to leave without grounds. And now the tenants unions fought very hard to get this one because they're sort of saying, how can an owner of a property kick a tenant out without reason? Now, the fact is that some of these people aren't considering is no investor is going to kick a good quality tenant out that maintains their property to a very high standard and always pays their rent on time. The only tenants that have been asked to move on are those tenants that are either or doing both, not paying their rent and not caring for the property. Another one is renting with pets, which sort of ties into the one I just mentioned. Investors in Queensland won't have the right to unreasonably refuse the request of a tenant to have a pet. It's pretty crazy rule in my opinion, because again, the investor's the one that's worked hard to buy this property, and they're the one that has all of the risk in the condition of the property and the commitment to the bank. So a good agency will sort of find some ways for an investor if they're not open to pets, because we know from experience firsthand that pets can cause significant damage to a property over and above the bond, that it really drives the point home about investing in a quality property manager that knows how to manage and handle that situation for you. And the third one being minimum housing standards. And that's in relation to predominantly private landlords who aren't maintaining older properties. Safe steps, safe balustrade or handrails, replacing equipment that is included in the rent when it breaks down and deteriorates and things like that. There's a lot of regulation covering most agencies to be compliant in that regard. Not as much pressure for private landlords from the government, also from the tenants, because unfortunately what we see is a lot of undesirable tenants who can't rent through agencies end up going and finding unsuspecting private landlords who don't have access to the same resources to check on the tenancies that we do, renting to those undesirable tenants, exposing themselves to a lot of additional risk.
Just as a matter of interest, do the new laws define what a pet is?
We're still to find out, Terry, and one example we sort of came up with as a very quick one was an owner could easily say they may have an allergy to pets and to some extent in the future tend to move back into the property. But yeah, they need to really expand on a lot of these. They're working closely with the industry body here in Queensland, the Real Estate Institute of Queensland and the Queensland Government and the tenancy advocacy groups to try and ascertain and narrow that down. But I think the 2 primary categories are cats and dogs. And then they'll have a subcategory for sort of birds, fish, and things like that.
Okay.
Yeah.
The laws we're talking about, which were recently passed in state parliament, they don't, well, not all of them come into effect instantly. I think some of them don't come into effect until about this time next year. Is that the case?
That's correct, yeah. So the domestic violence is the only one that's coming, that stayed as part of the COVID regulation. It was a temporary regulation, but that one has stayed, and the others will come in around about 12 to 18 months.
Yeah. Quite apart from the changes that were announced by the state government just in the last few weeks, previously they mandated some conditions about smoke alarms in rental properties, and owners have until a certain deadline to comply with those, I think.
Correct. So that's till January 2022. So the smoke alarms need to be the new type technology with a 10-year lithium battery and what's called interconnected. So there's one sort of mother alarm, and then there's other little babies that sit off it, and they all have to talk to each other. And I think the basic home might have to have 6 or 7 alarms, like a 4-bed, 2-bath home will end up having 6 to 7 alarms. 6, I think, if it's low set, and 7 or 8 if it's high set. That cost to investors around about $800 to maybe $1,200 to get that compliant by that time frame. And if you're not compliant by 2022, theoretically speaking, you won't be able to rent that property out. You certainly won't be able to do it through an agency, because the risk for us is, again, greater than it is for a private landlord, and a little bit more regulation and compliance there. Checking, the same compliance and regulations apply, but there's far more checking on us as agents. And that sort of comes about from there was a fire in the Logan area that a family of 11 people passed away in a couple of years ago, and they found that the alarms may not have been working in that property, unfortunately.
Okay. So people are running out of time to comply with that particular previously mandated rule about smoke alarms, which needs to be in place, I guess, effectively before Christmas, because it takes effect from the 1st of January.
That's right. And then there is a little bit of a grace period, and it applies if you haven't done a lease renewal or a new lease. It doesn't actually technically apply till then. But look, I think best practice would be for fear of missing that or getting it wrong, is to get it in, because the implications, obviously, other than the financial ones, are the fact that some tenants may die in an investor's property, which is a lot greater than any financial implication. Definitely worthwhile putting pressure on your property manager, if they haven't already contacted you about the upgrade, to contact them. The onus is on you at the end of the day as an investor. Yes, you are employing that agency to do the job for you, but as a lot of people don't know, it is sort of outside an agency's scope. Although the vast majority, if not all agencies I know, are undertaking to provide that service included in their fees. Technically speaking, if we, in my understanding, is if we dug down into the crux and the terms and conditions of the management agreement, it isn't actually a requirement for the agency per se. So if I was an investor and I had an upgraded, I'd definitely be making the moves, putting a bit of money aside to make sure that I was compliant by January 2022.
Okay. Look, we've got quite a few questions and comments. Maybe we'll start to turn our attention to them. And the question from Michael is actually a question I wanted to ask you as well. And it relates to the confirmation that Brisbane's going to be hosting the Olympics in about 10 years' time. And I was been thinking about what impact that might have on markets, particularly in the city ones. And Mike was asking, how do you feel realistically be the impact of the Olympic Games on an investment property, say an apartment in suburbs like Kangaroo Point, Wollongabba, close to the Gabba, which is going to be the main venue for the Olympic Games?
Yeah, fantastic question, Mike and Terry. I personally believe this current demand that's been increased from the interstate migration and all the extra pressure that's been put on the market, as that starts to wane in possibly 3 to 4 years, that what we will see is the infrastructure spend for the Olympics come in, let's say 2025, 26, and with massive infrastructure spend, we see an increase in jobs. With an increase in jobs, we see extra pressure put on a housing market. And that in turn translates to extra demand on rental properties. So personally, I think that we'll see, I think many industry experts are now predicting we could see up to 20% growth in Brisbane next year. But we might see that wane over about, say, 4 to 5 years. And in the long term, I personally am predicting the property market in Brisbane to double in the next 10 years. And that's primarily because of the Olympic Games being confirmed for Brisbane. And as I said there, that's driven by pressure and demand. As we know, supply and demand dictates price. And that demand will come from the infrastructure spend and the jobs. So I think as we discussed before, the housing and the apartment or unit market, they have their different times in a cycle. And that'll be a time when there's a lot of interstate, but also international migration and interest in Brisbane. As I mentioned on our previous webinar, I believe, Terry, I found an article from an independent research fellow from the University of New York who had studied the last 5 cities to host the Olympic Games and found that each on average, those cities benefited by 19% additional capital growth over and above the other capital cities of the host nation. So I think Brisbane is it's a very, very exciting time to own a property and own an investment property in Brisbane. And I certainly wouldn't be thinking about selling. I'd be looking at buying another property.
Yeah, and there's also research. There's been research done by a number of different entities recently, and the outcome, I think, 2 of the research reports I've seen is that the suburbs closest to the main venues for the Olympics tend to have a higher capital appreciation than others. So that would tend to, if that's true, it would indicate that suburbs clustered around the Gabba, which is currently Brisbane's main venue for AFL and cricket, which is also going to be the main venue for the Olympics, not the only one, of course, but certainly the opening and closing ceremonies. Therefore, suburbs like Wollongabba, Kangaroo Point, East Brisbane, perhaps Annerley, Greenslopes might be worth considering with that point in mind.
Yeah, absolutely, Terry. I think they call it the starfish effect, in that if any capital city market, you can see the starfish effect happens around the rail lines, in that it follows out and tapers off the further away the railway gets from the capital or from the CBD. It tapers off and looks like a starfish, because generally you see train lines going off in sort of every direction in sort of a bit of a pie, sort of a spider effect. And the demand that's going to come from, again, going back to that, the infrastructure needs to be built or upgraded, as a lot of these projects are existing infrastructure that needs to be upgraded. And what that does is those people have the tradespeople and construction industry have to come, and they'll be working on those for 2, 3, 4 years. And a lot of those people like to live close to where they're working, and then that puts early pressure on the housing market in that area. And if they're not living, say, in Wollongabba or close by, for instance, and commuting or driving to work, then they're going to the next suburb out of the suburb after that. But with the increasing pressure put on our roads, people are looking to get closer and closer to work, and the construction industry don't have the privilege of working from home, from like a lot of other people do during COVID. So they have to find housing solutions close to their work.
And the question is, of course, always, where are people working? There's a question there from Mel, which I'd like to touch on, because he's speaking about distance from the CBD. I always think proximity to the CBD is overrated as a consideration for property investors, and particularly as time goes on, and particularly as a consequence of what we've seen with COVID. But Mel's question says, obviously, the further out from the CBD property prices decrease. How far out is too far from the CBD for maximum return? Is 1 hour too far out?
Look, good question, Mel, and thanks, Terry. I think in Brisbane, an hour is well and truly outside the outer ring. And as we discussed before, I think certainly if you can get within the inside of the outer ring, which is sort of around about that 20 kilometres, 22 kilometres. And in Brisbane, that's around about on average, probably a 45-minute commute to the city is as far as I would be going, certainly. And I think if you can and your budget allows, then try and get to the closer you can get to the city, the better, naturally. And if you can find somewhere to get as close to that middle ring as possible, a sort of 10 to 12, 15 kilometre, it might be a larger financial outlay initially, but you will benefit from higher rental returns and better capital growth. So finding that, I think they call it suburbs for gentrification, is another key, is finding a suburb which has been held back potentially through a lower socioeconomic demographic, and the surrounding suburbs have increased around that suburb, but that one's been held back. That's certainly a good property area to invest in, because the disparity between those and the surrounding suburbs is unsustainable, and it can't stay that way forever. So eventually, owner-occupiers and investors pour into that suburb and start to revamp the infrastructure and the housing, and it goes through a little bit of a boom, and next thing you know, it's overtaking the suburbs around it.
Yeah, I think there's a bit of a fallacy that people still have in their heads that everybody works in the CBD, or most people do. In fact, most people don't. The vast majority of people work in suburban employment nodes, not in the CBD. I think that's going to be increasingly a factor as we go on, partly as a result of the COVID, but I think that was the case even before that. For example, we've been talking about those sort of middle ring areas on the north side of Brisbane. I think the biggest employment node of all is actually what we call the Australian Trade Coast, which is the commercial industrial precinct around the Brisbane airport and the seaport, which are located quite close together. That's a massive jobs node. So a lot of people living out there actually be working in places like that, not actually travelling to the CBD to work in normal times.
Yeah, that's right. And even fuel with COVID, and businesses have learned if they weren't already ready for remote working, they've been forced to do so through lockdown. And a lot of the bigger companies, national companies, and even state ones have realised that they may not need a base necessarily in interstate, and they might not need a base in city or the CBD. So they're attracted to cheaper rents in the outlying suburbs or hubs, and providing flexibility for an ever-changing workforce. That has certainly meant, but there are some areas like you said there, that are Virginia, Nudgee, they're in that sort of middle ring, but also close to that massive Virginia light industry, commercial, and then the ports and the airport. And you can really sort of, I guess, hedge your bets in that regard. It's not unusual to have someone in that household possibly even still commuting to the city for work.
Yeah. But a lot of people aren't because they don't work in the city. I've just actually been doing some analysis. I did an analysis for Sydney showing that the long-term capital growth rates for suburbs in the greater Sydney area, the 10-year averages, and the suburbs with the biggest 10-year growth averages were actually in the outer ring areas in some cases. But there were, very, very strong growth markets in all sectors of the Sydney market. And I think that's probably true in all cities. It's certainly, there's no research evidence to support the notion that you get better capital growth the closer you're into the centre. That may have been the case historically, but it's certainly not the case in modern times. Frank is referring to forecast the Brisbane property market 6% growth next year, 1% growth in 2023. Does it mean it's too late if we're looking for double-digit growth? Look, Frank, I think, I don't know whose forecast you're referring to, but I would say, frankly, that they're rubbish. I think, Brisbane's just starting on a growth cycle. There may be a moderation in the rate of growth, but I don't think it's going to be as low as 6% in 2022. And I think Brisbane's going to be a growth market for the foreseeable future. I think Brisbane's going to show growth for the next 10 years. So the past 10 years have been mediocre. The next 10 years are going to be much stronger. It's not just this year. It's going to extend further for multiple reasons, including the big infrastructure spend, the population figures, the affordability comparison, Brisbane's image of having managed the pandemic better than the big cities, and in particular, the impact of the 2032 Olympics. And the research shows that it's in the lead up to the big event, like the Olympic Games, that cities that host them have the biggest impact on real estate prices. So I think Brisbane is going to transcend those forecasts. What do you think, Mark?
I agree 100%, Terry. And I only just I looked on, compiled some information yesterday. I think the four big banks and the Reserve Bank of Australia, if you look at the mixture there, that's roughly, generally they're all double digits for next year. Some up to doubling, 20% next year. And to give you an example, I think the CoreLogic's RP data released the figures just last week or early this week, which were that we have received on average in Brisbane, 7% in the last quarter. So that sort of is over and above that 6% for Brisbane already just in one quarter, let alone the year. And I agree 100%. 10 years worth of growth. I think, let's say we saw 20% next year. We might only see 15 the year after, or 17, 15, 12, down to 10, a little bit of a lull as it wanes, or even down into single digits and then wind back up as we get closer. And agree 100% in that most of the growth, research growth, is definitely before the Olympics. And that comes from being in the international spotlight, that infrastructure and jobs spend, as we discussed earlier, and also the fact that our market has been suppressed or subdued for 14 odd years. We've missed a couple of cycles compared to Sydney and Melbourne. So the disparity between Sydney and Brisbane and Melbourne and Brisbane has never been greater in recorded history. And it's unsustainable. Property prices are 3 times as much. And I know they're not quite this, but as for ease of an explanation, property prices roughly in Sydney are 3 times that of Brisbane, and in Melbourne they're twice the price. It's no wonder that with the way we've handled COVID and our affordability, that people are, deserting those capital cities to move up here and invest in Brisbane, and they're blowing away the local buyers because they're coming up with strong money and outbidding us, and that's what's forcing that growth.
I think that the price disparity between Sydney and Melbourne with Brisbane is one of many reasons why Brisbane is going to grow. I don't expect Brisbane will ever completely close the gap with Sydney, but having values less than half those of Sydney, I think a natural level with Brisbane might be about 75% of Sydney. So I think there's capacity for Brisbane to grow considerably in addition to what it's done in the last 12 months. Mark, we've got quite a few questions from people about the Logan City market. It's one that's perhaps underachieved for investors for the past 5 or 6 years, but for the past 12 months has become very hot, very busy. How are you finding it?
Yeah, that's right. It's probably primarily to do with the demographic, but that's an opportunity because as we see, try and answer as many of those questions as I can see in one go, is people asking about particular area and suburbs that, look, let's say we saw property values double in Brisbane over the next 10 years, that even those underperforming suburbs will get picked up in that uplift. None of those suburbs are going to be left behind. So some might see 100% growth, and others might only get 90. Some others might get 110, but the average will be 100. But you certainly wouldn't be complaining about 90% growth, as you naturally wouldn't be about the 110. But that will filter out to the south, to Logan, to the north through Moreton. There's also, as we discussed in our last webinar, a lot of infrastructure spend independent to the Olympic Games being put into those corridors and the transport down around that Logan area. We'll see that as investors and owner-occupiers, first-time buyers already did their sort of bit, and first-time buyers sort of stimulated the market through government stimulus, and then as that got withdrawn, the owner-occupiers entered the market, and now we're seeing investors entering that Logan market. And they're paying more and more for properties. People are getting better returns, and we'll see the prices go up, and tenants will be forced to pay more. So yeah, look, I certainly think it's a great opportunity, especially if someone's sort of driven a little bit more by budget to get into that area, into that Logan area.
We've also got quite a few questions about Ipswich City, which in many ways is similar to Logan City in pricing in the south, but in the southwest. So we've got questions about Redbank Plains and Bellbird Park, for example, but probably a similar scenario to Logan. Vacancies low, demand high at the moment.
Absolutely. Look, I think someone just sort of seeing more questions coming up about Brisbane areas. Just to reiterate, I think that all of the greater Brisbane, if not to Sunshine Coast, to Gold Coast, out to Toowoomba, will benefit from the current demand and the future demand from the Olympics. I personally don't think you can go wrong in any of those areas. So it's about preference. Naturally, some areas that are already strong will maintain to be strong. Others will will weaken, and some of the poorer performing suburbs will outperform some of those better ones. It's very hard to say which suburbs will do better than others. You're probably a better person, more qualified to provide advice on that than myself. But my general advice to people is just to get into the market in Brisbane, and in Greater Brisbane or Southeast Queensland. In any area, I don't believe you can go wrong.
But again, you do need to be just a little bit careful about what you buy and where you buy. It's not a case of just buying anything. As we've been discussing throughout today's webinar, look, we're just coming up to the hour mark. We've got quite a few questions. I just think if I could just quickly zip through and respond briefly to a number of the questions that are there. Frank's asking about the Nunda to Chermside precinct as a considered strong growth potential. We've kind of talked about that middle ring north side area previously, and I think Mark and I do agree that that is a market that's got good potential for growth, a nice compromise between affordability, reasonably good rental yields and prospects for growth. Akil was asking, we've just touched on the Ipswich market. He was specifically asking about Redbank Plains and Bellbird Park, which I think are places that will show good capital growth. There's been an enormous uplift in sales volumes in suburbs like that in the last, say, 6 months, and that will translate into price growth. Matthew asking about Toowoomba. Are we sort of grouping that with Brisbane in terms of our forecast? Look, Toowoomba's a market not too far from Brisbane, but it's a market in its own right. I think it's got its own very strong reasons for growth. I think it's going to be one of the better performers in Australia going forward. It's got so many major influential pieces of infrastructure influencing growth there. It's asking other suburbs with long-term issues you would not invest in. Doesn't Logan have problem areas? Look, I think such issues tend to be overrated, that down market areas are going to necessarily produce bad tenants. Look, in the current climate, with vacancies so low, and as Mark has pointed out, it's not unusual to have 20 or 25 applicants for an individual property that becomes available for rental. If you've got a good property manager, and I mean a good one, it's important to have a good property manager on your team. They should, in their normal process, find you the pick of the crop. So you shouldn't have any concerns about tenants if they do their job properly, as Mark has articulated during the broadcast. Let's see, just flicking through. What type of property is best to purchase? Eva, we get a lot of questions like that where people think there's a right answer to a question. Quite often the right answer to a question, and what's the best type of property to buy, it depends on the individual. It depends on you, your circumstances, what you already own, what your risk profile is, what your objectives are. Are you looking for strong capital growth? You're looking for a high rental return? All of these questions influence the answer to that question. It really depends on you as the buyer as to what the correct answer is. There's no one right answer. There's no one size fit all, as Mark has pointed out previously in the broadcast. We've talked about smoke alarms.
Just while you're going through looking at those, Terry, I'll add that I'll get a download and a printout of these questions and who they're from, and to get back in touch with people directly and address any of the ones we didn't get to today.
Yeah, okay. Well, I think that's actually a great way to handle it, because we could go on for another half an hour and still not answer all the questions. So Mark is rather foolishly undertaken to go through all the questions and to give people answers. There's so many varied questions. There's questions about the Sunshine Coast. Do we see the Brisbane forecast growth extending to the Sunshine? Look, the Sunshine Coast has been growing strongly for the past 3 years. It's been one of the most outstanding markets for capital growth in Australia for the last 3 years. It's already well on the growth path. It's not influenced so much by Brisbane. It's got its own reasons for growth. It's going to be a great place to own real estate long term because of what's happened in that city with infrastructure. But we probably need to wrap it up. We've gone over the hour mark. Perhaps just before I do a general wrap up, some parting comments from yourself, what people should do if they want to make contact with you, for example.
Yeah, thanks, Terry. As I said there, I'll go through those things in the coming weeks. I'll get back to everybody. It might take me 2 to 3 weeks, just so please be patient. and I'll sort of work through in the order they've come in and get my way back through all the people. And I think it's probably better that way too, because these, as we said, it's really quite personal. There are so many determining factors which determine the outcome or the answer to those questions, and they are quite personal at the end of the day, and that they might only apply specifically to that one person and not to other people in the group. Invest in a quality property manager. It is really an investment. You have spent a lot of money on a property, so just go that little extra step. I sort of coined the phrase that a cheap property manager can end up being very expensive, and I've lost count of the amount of times I've seen that happen. I'll circulate to Terry and his team my notes for today for people in follow-up email that'll go out as well, with a bit of a special offer from us here at Bluestone Property Management. And just wanted to say thank you, everybody, for your valuable time and to jumping on board and listening to today's webinar. And please don't hesitate to contact me directly. My contact details will be made available by Terry and his team in that follow-up email. Thank you.
Okay. Well, thanks, Mark, for your contribution today. I think it's been really informative, lots of great information and lots of good advice for people who are already in the Brisbane market or thinking of getting into. I think it's going to be a great place to own real estate going forward for the next 5 to 10 years. I think Brisbane's going to be a growth market, one of the leading ones in the country. But we do reiterate the point we made right at the start and throughout the broadcast that it's important for people, even in rising markets like this, to show some care in terms of what you buy and where you buy, and in particular, how you behave as an investor owner to get the maximum benefit out of your investment. Okay, that's it for now. Thanks everyone for your participation. We will be sending out copies of the broadcast and with contact details, how to get in touch with Mark Shorrock of Bluestone Property Management and Sales, should you wish to do so. Thank you, Mark. Thank you, everybody.
Terry. Thank you.
Bye for now.